Hi, good afternoon. I thought we'd just do a quick video as there's been some interesting moves in the oil complex for the last month or so. I'm not going to kind of read you the news and tell you that crude's gone down considerably because, well, there's plenty of people on Twitter you can follow to post charts doing that. The interesting thing I wanted to show everyone really is around what volatility's done, which has obviously been considerable over the last few weeks. Hold on a sec. So, just bring this up here. So this is front month, and I believe so it's Jan and March crude. We already had 2 weeks ago the spike. We were kind of sitting around this 30 mark. It had been a while as kind of crude came in from what looks like, where was it? Even in the high 60s there, it already kind of made that jump into the 30s, but volatility before anyone had kind of really thought of anything else. And then we had that first leg down into the high 50s. And then really, vol's just kind of gone on to a major explosion. Front month actually traded at 70%. I'm not sure if this platform picked it up, but I think I got paid by somebody at 70.4%. Late in the day, just before the close. So that's marked the vol at 67.8. But even 3 months out, it's trading 53%. So we're seeing a significant vol spike. But the real interesting thing to show everyone is actually what's going on in the risk reversal, because why we have obviously over the last 2 weeks, 2 full weeks here. We don't really need to kind of be going back and messing around any further. The picture's kind of plain to see. Same 2 months again. I think we've seen crude up at 61 here. So we've already come down kind of $10. But Vega didn't really move that much in the early days of the move. It was very late onto the topic. If I find another chart, hold on a sec. Hi, sorry about that. I just seem to lose the ability to use this system. As you can see, this is 30-day implied vol against realized vol. So just kind of ignore the realized for a second. But as crude kind of was up here in the 70s, and then obviously we fell off. You didn't really see any movements in implied vol really until the acceleration move happened, breaking below the 63, and then all we've had really here now is just a bit of chaos. So it's just literally gone up in a straight line here. So, but that's quite a normal thing to happen. That I was just trying to say that the move's been the vol move has been very, very late. If we just go back to where I was before. Just wait for this to load up. So the kind of key thing to note here for the first time is the risk reversal. So just to recap what the risk reversal is. The risk reversal is you're looking at taking advantage of a movement in the skew. So we can look at that. It's kind of highlighted here. Just wait for this to load up. So this is the January contract. And you can easily see the 20 delta, the 20 delta volatility is 75%, and the equivalent 20 delta on the call side is 59%. So the risk reversal by selling puts and buying calls, you're taking a 15% in your favour. So if the market, what normally would happen when people would trade risk reversals at tops and bottoms. It's better to trade the risk reversal with crude because at the bottom, because it gets so puts bid. Even you tend to find if crude rallied really, really hard, you don't go calls bid that much. So it's a nice play for always kind of selling the put and buying the call. It's a great way of naturally, it leaves you long anyway, because obviously selling a put and buying a call would do that for you anyway, especially at 20 delta. They would split you across a total of 40, and you would be long, and you would also be getting paid for the volatility in your favour in that movement. And we're starting to see over the last day and a half, the 20 delta risk reversal really represent that. So you would expect all we've seen is slowly, if we just focus on the H, because there's only 20 days left in the January. So we're kind of minus 5% already, because this is only 2 weeks. We're already showing that puts were bid up anyway. We came in minus 10%, kind of settled a little bit. And then slowly, as crudes continue to fall, we've seen it come all the way out to kind of 20% at its peak on Friday. But we've seen a considerable fall in the underlying price down to kind of closing on the lows. If that button will work. Why's that not doing that? Weird. Yeah, the futures price there is 50.40, but look at this. As someone's really come heavily into the market to take a pretty lumpy risk reversal position. 20%. I mean, it's just bonkers. I mean, and on the month 3 as well. So on the March, 15%. I mean, everything favours you making money on that, because you'll will end up kind of mildly short Vega, mildly long Vega. In the move, as the move goes up, you end up getting shorter Vega. So overall vol, we're not that worried about the at the money vol, but you'd be at the money vol short mildly, and those wings would just collapse. So that's kind of an interesting play, and that's the first time I've seen such an aggressive risk reversal purchase going on. You can just see they've moved that all the way from minus 20%, actually finished the day 8.8%. I mean, that's just vast shift in the curve. It's quite a profitable trade, because if we now see some rebalancing, we could easily see the risk reversal come back into 5%. Now, what would that mean for the underlying price? We could quite easily see a movement of maybe easily 10-15% back up. The five delta skew is interesting as well. Is that they're really getting kind of excited that those wings were moving, and you can see here in the latter part of the day is those puts were just basically swung entirely the other way. So the January, I mean, at one point was 15.47 against, ended up 34.15. It's just, I mean, that's just a ridiculous move. So there's definitely some aggressive buying of that risk reversal. Just a quick look at the term structure on the futures contract. Looks, I mean, obviously it's sitting down here anyway, but the contango has not increased that much. So if we focus on, where are we? Z19. So a year out, where are we? 51.66. So $1.50. Yeah, $1.20 for a year out contango, whereas we were, let's say 30 days contango. Well, 650, 60, where are we? On that. 66. Yeah, it's stretched. The contango stretched out about $1 across the curve, so it's not a huge amount. Interesting. I normally kind of avoid looking at volume, but it's quite interesting the lack of any volume below 50. There's 20,000 out here in the deck. 19s, but that's probably some, serious protection. You'd see the same thing here, 20k out in the Junes. But there's nothing really short term. There's just a bit of a void. If you look at everything above here, it's all happened so much. There's so much dead gamma up here for all the call buyers. They've just got nothing left. And it just looks a bit bleak down here. Could be interesting. It's actually, people say, oh, it would just fall into a cavern of lack of interest. It kind of tends to be the opposite. It tends to kind of fizzle out, and you'd see a rebuild back into this kind of this 55 level while everyone puts downside volume on. Interesting view of the skew there. So not particularly. I should try and move the month. Hold on, that's just is a little bit of an aggressive view on the skew. let's look at the March. You can just see, I mean, you know, we're here, the vol path now, the vol belly is up in the 70s. Usually crude's vol belly would normally be $5 higher. So if where I'm pointing here, if I just put the marker back on, make that freehand, usually if the kind of at the money was here, the belly would just be about $5 above. You can see the at the money's here. Yeah, we've just got this entire slope before we hit the belly of between, so we're up at $18. So, you know, people now, 20 delta risk reversals kind of are still on the slope rather than on the belly. You would usually find that, you know, if you've got kind of, if that's the at the money here, your 20 delta risk reversal would non-belly across there, or probably, sorry, that's incorrect. Let me do that again. So if normally your 20 delta would be here like this, and you'd be trading across that line and getting the real trough. You're not. You're here. You're kind of 20 deltas. Oh, I've not got 20 deltas on this. Hold on one sec. Oh, show even deltas. Geez, that's a bit messy now. Look at the odds. Sorry about that. So, as I was saying, your 20 delta risk reversal at the moment is here and here, and you normally would say your 20 delta risk reversal in crude is kind of usual. Is if the at the money is here, it's here and here. So you're across that point. Here you're still deep in the slope. You know, so it's great value. I mean, it's just lifted so much, and you can just see now. You know, the distribution is so layered across to the top side. It's phenomenal. But we've got another $12 for one standard deviation, so the 40s should start filling up now, and then 63 on the upside for another standard deviation. Sorry. And the last thing I wanted to show was, I've seen that. Time structure, seen that. Cost of carry has not changed. There's nothing of size that I've seen coming through. This is the last thing I'm just going to kind of bore everyone to death with. This is WTI vol against Brent vol moved across a standard curve, so maintaining the current WTI Brent spread, which is circa between $8 and $10. So it's tracking according to the spread, the at the money vol, and then it's also it's removing any vol risk. So you got to remember, as the price of an asset falls, if you know something if crude was down at $10, volatility is naturally, if there was not much Volga Vega hanging around, it would still be 45-50% because it's percentage chance of movement. That's how it happens. So crude up at $100, natural resting volatility is less than crude down at say $10, because you could easily get a points difference move of, you know, $1, which is a 10% move. Well, 10% move at $100, you know, requires a $10 move. So that you need to kind of discount that to come out of it. But what I'm trying to state here is, usually you'll see that Brent and WTI's vol is always staying together, but over the course of the last month, we've seen some gapping, and that gapping hit its a 3.36% spread. It's usually within a 1.5% spread. And this goes back all the time, and you'll see that the actual underlying price have stayed fairly well balanced to each other. Hopefully, can I just this work for me? Yeah. So you can see here, like, there's not that much variance. You know, it's stayed in that channel. All right, and vols usually stayed in that channel, but we can starting to see that WTI is slightly overdone. You know, we're seeing big gaps, and that's representative here. So minus 3.36. So it's something to bear in mind. It just, when that elastic cord stretches to the max, it will snap back. And coupled with the risk reversal purchasing that I said earlier in the video, and coupled with, we have seen some massive, huge oversold in the underlying, we could certainly see a snapback. I don't really care if the underlying moves or doesn't move. For me, I'm saying we might see a period of stability by a week or week and a half, where that skew shift will happen dramatically. And while everyone else is sitting there getting chopped up, you can make a lot of money with that naturally falling in your favour. Cool. Have a good trading week. I hope everyone does well.